If you guys are looking for a guide that can help you understand fair value gaps properly, mark them on your chart, enter trades properly with them, and know when to not take them, this is going to be the guide for you. This guide is going to help you understand when to market your fair value gaps, when to look for them, and actually how to properly enter them without getting slipped in the market or entering on a bad fair value gap that takes you nowhere. This fair value gap guide is going to help you turn from beginner to expert in just in a matter of minutes. If you guys do enjoy it, make sure you guys like, comment, and subscribe, and also join the free Discord if you guys are looking to get more information and trade live with me every other day. Also forget to follow me on my Instagram and TikTok where I'll be posting content on there every single day. If you guys enjoy this, again, make sure you guys like, comment, and subscribe, and let's get right into the guide. So the key thing is super simple with fair value gaps, and fair value gaps are actually imbalances. There is a family of imbalances like the new week opening gap, the new day opening gap, and volume imbalances. Fair value gap just plays one of the most popular roles in trading, period, to understand market direction and to understand different sentiments in the market. Imbalances are simply just unbalanced price action within the market. Price is always going to see itself going back to those levels to either fulfill unfilled traders or to respect and disrespect that to even push into the opposite direction. So for Vegas specifically, what they do is that they feel the same thing as every single other imbalance does. They help push a direction or they help get disrespected so you can understand where else they're going. And lastly, what they do is that they fill limit orders for the traders who have not gotten filled in yet and help them be a part of the move. So in order to identify a fair value gap, you need three things because it is a 3 candlestick pattern. Your first candle is your beginning candle. It will help structure out everything and helps you become the beginning of a fair value gap. The second candle will be the gap of where the fair value gap forms. It will actually make sure that you actually have a fair value gap in the first place. And the third candle is the third candle that locks off everything to make sure the fair value gap is closed and secure. To draw it out in this bullish example, is going to be the top of the first candle across the second candle to the bottom of this third candle. Draw it across, and then you have your fair value gap. The moment that you draw this out, you notice that the candle right after fair value gap is drawn slides right back into it, respects it, and closes a lot higher with the rest of the move pumping up more. So what does this mean exactly? Because we are bullish and the fair value gap aligns with where the market direction is going, we trade back into it, we pump higher because we filled all those orders, and now we're allowing price to push higher and disrespecting this fair value gap. Whoa, disrespect a fair value gap? Yeah, you can actually disrespect fair value gaps because, for example, this bearish one, like the first low, this one, cross the second body to the top of the third body, which is your bearish example, we notice it get ran over here because we have a close above it. What does this mean? In any fair value gaps or any imbalances, that means that you can also inverse them. Now, what does that tell you? Inverse imbalances or inverse fair value gaps help you understand that the bias could be flipping, the market could be going other direction, or it could be looking to stop out those traders who have got their fills and looking for liquidity to push into a certain direction. Let's take an inversion example so you guys can understand clearly like how this stuff really works. So we have a bullish fair value gap here drawn out. Now, for those who are new and those who are just taking fair value gaps without any context or any deliberate idea of where the market can be going, and they're just taking any one, this is where you guys fail the most. You guys need to have context with your fair value gap or any imbalance that you're taking, because that will increase your probabilities for your win rate to increase. If you are being the ones who are just taking any single fair value gap because they have to be respected, you're wrong. No single fair value gap needs to be respected because it needs to be aligned with context. The more confluences that you have aligned, the more context you have aligned with your fair value gaps, you're going to see it move in your direction. So with this fair value gap bullish example, if you are long and you're bullish, it respects it, and you get your long right here, or you're into long at a limit order at the fair value gap, you quickly notice that you get railed fast, very fast, within 10 minutes fast. That's pretty bad. Why does this fail exactly? Because we're clearly bearish. Respecting this fair value gap because we have yet to close above it. As you can see, the first candle's low. It's not been a body close above. But we do close above both of these imbalances at the same time, inversing them both. What does that tell you? That tells you that we're clearly going down and inverses those fair value gaps. So you can see that how fair value gaps can tell you sentimentally where the market wants to go if you're using them properly and you're paying close attention. What does that mean? Yes, you could absolutely use these inverse fair value gaps as an entry point because you see eventually it trades back into them, reject, and we continue lower for the rest of the day. It's a very key thing to understand how fair value gaps work because fair value gaps help direction the push of the market. Fair value gaps can't form unless there's certain type of momentum because we need a gap as a second candle body to even form in the first place. So if you have that with in mind, then you understand that fair value gaps are very crucial part in understanding momentum and pushing towards your opposing liquidity. I'll go more in depth about inverse fair value gaps in another video, another clip, but you will understand that how fair value gaps are so important. Now, in our previous example, you can see how we inverse the fair value gap and continue higher. So if you entered on this candle, you can see how we push higher and you would have made profit. Inverse fair value gaps are super key, and I hope this was super simple for you guys to understand. Apply it to your charts, apply it to your strategy, and make sure you guys are using it with context so you guys can actually see these coming to fruition. With more back testing and more replay, you guys can actually understand how these fair value gaps are kind of acting, kind of understand which ones are actually more probable than others. Some of them are going to be super big, some of them come in super small. All fair value gaps matter because they all are imbalances in price, and price wants to come back to those imbalances to fill those orders. You never know, your order could be one of them as well that price is going to come back down to and fill, because price is algorithmic. So go back and study these. It's going to be super easy to find out how fair value gaps move and how fair value gaps form. The next imbalance we're going to talk about is void. Voids are simply a gap within the market with no wicks passed or no bodies passed. An example would be this bearish example here. There's absolutely nothing in this range. No wicks overlap between these two candles and no bodies overlap between these two candles. This is going to be your void. And notice when our wick comes up to try and fill something in, there is no fair value gap here. The void rests right here. The void is an imbalance because resting orders did not get filled because the market skipped down price and we left us a void or imbalance for us to fill. And as we tapped into that imbalance, you can see that we jumped heavily to take out that recent low before we push up again. Voids are a great way to understand how bearish or bullish the market can be because voids move very fast. Market has to move very strong momentum to create these voids. So having a void present first and foremost can help you understand where the market wants to go entirely. The next gap I want to talk about will be a volume imbalance. A volume imbalance is a little bit like a void, but this time only the wicks can overlap. So in this example, is a bullish example. There's two wicks overlap. This wick overlaps with this wick, leaving the gap here, and that will be your volume imbalance. You have to make sure that none of the bodies touch, only the wicks will overlap, creating a little space there. That will be creating your volume imbalance. As you can see as an example, this is also a void with unfulfilled orders because no bodies pass. Now price comes back and taps this level because it's a void, it's a gap, it's an imbalance, whatever you want to call it. Price taps it and pushes higher, takes out this liquidity, and also respects these fair value gaps here. If you're advanced enough, you would use this as your target before price comes back down. The volume imbalance is another great imbalance you can use for short term to catch a quick little scalp, a quick little long or a short, so your low hanging fruit. The next imbalance I also want to talk about will be your new week opening gap, or also known as the NWOG or NWOG. NWOG or new week opening gap is simple. It's self-explanatory really. Truthfully what it is when the Friday closes and the Monday opens, creating a void, just like we call in a lower time frame. This time the time is important because it has to be a Friday close and a Monday open. This gap is super important because price likely will find itself drawing back here because this is a really big void because it's a new week and you will always see price coming back to it having strong momentum. In this example, this is our recent new week opening gap. Friday close, leaving this high, and then Monday open, gapping higher. Therefore, it will be at this candle's low. And as you see that we traded back into it, respecting it, opened again, and we came back down, tap consequent encroachment, which is the middle, any gap, and we're starting to push higher. New opening gaps are great for setting targets if you're getting close to there, or they're great to seeing if you want to react and bounce off those levels or completely disrespect off the level. And just like new week opening gaps, you have new day opening gaps that you can use. You have a gap between Tuesday, you have a gap between Friday and Wednesday. So Tuesday's close and Wednesday open. You have a gap between the two, or volume imbalance on a higher time frame because it separates between the days. And you can see the next day that we completely come through it, using it as an inverse for us to go lower. All these imbalances try to tell you is where the market wants to draw back to, and you can potentially use those areas as areas to mark up, bounce off of, to disrespect, and understand where the most volume can be put for the day. Value gaps are a great way to enhance your trading, so make sure you guys are implementing them into your chart, actually using them as a way to understand your direction. Make sure you guys are not using them without a clear bias or without clear context, because then you can screw yourself over without knowing what you're doing. Hopefully that was a pretty straightforward explanation of what imbalances are in fair value gaps specifically. If you guys have any more questions, please feel free to leave it in the comment section. I will happily reply to them, or I'll make another video in one. Or we'll make another video in depth about inverse fair value gaps, about new day opening gaps, about new opening gaps specifically for you guys. If you guys are looking to base your strategy around them, I'm making a video so you guys can learn. But make sure you guys are back testing with this strategy and also using context so this can actually play out to your favor and not failing your money time because you're missing key pieces. So I hope you guys enjoy this video. Make sure you guys follow me on my socials, and my Discord is free if you guys want to join and join the community and learn more from me. I hope you guys have a good trading week. Peace.